History doesn't repeat, but financial patterns do, and today's story exposes one of the most powerful money mechanisms ever hidden from the public, because what happened in Lehman Brothers' collapse still shapes global finance today. September 15, 2008, 1:45 a.m., Lehman Brothers headquarters sits in Times Square, Manhattan. Dick Fuld, CEO, stood on his 31st floor, looking down at the city that refuses sleep, camera crews outside setting up, reporters showing up, the world watching. Hours from now, Lehman Brothers, a 158-year-old institution surviving the Civil War, 2 world wars, the Great Depression, would file for bankruptcy. America's largest bankruptcy in history. $639 billion in assets, $619 billion owed, 25,000 people losing jobs. The global financial system freezing up, stock markets crashing, banks worldwide teetering. The Great Recession beginning worst economic disaster since the 1930s. Here's what matters. Lehman Brothers didn't collapse from bad luck. It collapsed from a system built to conceal risk, reward reckless bets, and shift consequences from decision-makers to everyone else. That system didn't shatter when Lehman fell. It expanded. What really went down at Lehman Brothers? How does a company surviving over a century implode in under a year? Who caught it coming? Who had the power to stop it? Why'd the government let it die when they'd saved other banks? It's grasping how financial systems operate now and why the coming crisis might hit harder. Before Lehman Brothers turned into a collapse symbol, it held one of Wall Street's most respected positions. 3 German immigrant brothers founded the company in 1850, Henry Emanuel Mayer Lehman, down in Montgomery, Alabama. Cotton merchants initially, purchasing cotton from southern plantations, selling to textile mills. Post-Civil War, the brothers relocated to New York, transforming the operation into an investment bank. Next 150 years, Lehman Brothers backed some of America's most recognizable companies. They underwrote IPOs for Woolworth's Macy's, eventually 1990s tech boom companies. By 2000, Lehman Brothers ranked 4th among America's investment banks, trailing Goldman Sachs, Morgan Stanley, Merrill Lynch, 25,000 employees across 40 countries, trillions managed, about to make a choice destroying everything. Late 1990s, Lehman Brothers pulled most profit from standard investment banking, stock offering, underwriting, merger advice, wealthy portfolio management, profitable but dull, return steady but unremarkable. Then 2000 hit, dot-com bubble popped, stock market tanked, investment banking money dried up, Lehman Brothers hunting for fresh strategy. Found it through real estate, 2000 onward, Lehman Brothers pushed hard into mortgage lending and mortgage-backed securities, not just financing mortgages, buying mortgage companies, bundling mortgages into securities, trading them for massive gains. By 2004, Lehman Brothers dominated mortgage market positions. Profits exploded. 2005 brought $3.3 billion net income. 2006 hit $4 billion. Dick Fuld, the CEO, became Wall Street's highest-paid executives, pulling over $40 million yearly. They flowed from something far more dangerous, subprime mortgages. Understanding what destroyed Lehman Brothers requires grasping the housing bubble and subprime mortgages. 2000 arrived. Federal Reserve, led by Alan Greenspan, responded to the dot-com crash by slashing interest rates dramatically. By 2003, rates sat at 1%, lowest in 45 years. Borrowing became incredibly cheap. Cheap borrowing meant more mortgage access, more home demand meant climbing prices. Climbing prices meant existing homeowners feeling wealthier. They borrowed against home equity, spent more, economy grew, everyone happy. But something else brewing beneath, banks ran out of qualified borrowers, normal housing markets lend to people with solid credit, stable income, sufficient down payments. Prime borrowers, low risk. But by 2003, most prime borrowers wanting mortgages already owned them. So banks shifted to subprime borrowers, People with poor credit. Why would banks do this? They weren't keeping the loans. Here's how it operated. Mortgage company lends $300,000 to someone barely affording payments. Borrower signs, monthly payments start. But mortgage company didn't keep that mortgage on books. Instead, sold it to an investment bank like Lehman Brothers. Lehman bought thousands of these mortgages, bundled them together, created mortgage-backed securities, MBS, securities sold to investors worldwide. Pension funds, insurance companies, foreign governments bought these mortgage-backed securities because they paid higher returns than government bonds. Mortgage company made money from origination fees. Lehman made money packaging and selling securities. Investors got what they thought were safe, high-return investments backed by American real estate. Mortgage company didn't care if a borrower could repay because they sold the loan immediately. Lehman didn't care because they sold securities to investors. Investors didn't care because rating agencies, Moody's and Standard & Poor's, gave these securities AAA ratings, highest safety rating possible. But here's the trouble. Mortgages backing these securities were garbage, subprime borrowers with no income verification, adjustable rate mortgages resetting to unaffordable payments after 2 years, zero down payment loans, loans to people lying on applications. These mortgages got called ninja loans, no income, no job, no assets, and they were being packaged into securities rated as safe as U.S. Treasury bonds. By 2006, subprime mortgages represented 20% of all new mortgages in America. That's $600 billion in subprime loans originated in 2006 alone. Lehman Brothers played as one of the biggest in this market, but it got uglier. Lehman Brothers and other banks took these mortgage-backed securities and created something even more twisted: collateralized debt obligations, CDOs. A CDO grabbed the riskiest tranches, bottom slices of multiple mortgage-backed securities, repackaged them into new securities. So the worst mortgages, ones most likely defaulting, were pulled together, sliced again. Somehow, the top tranches of these CDOs received evaporated ratings, financial alchemy, taking garbage, creating gold through complexity. Investors worldwide bought them because ratings said safe and returns high. Lehman Brothers held over $85 billion in mortgage-backed securities and CDOs on books by 2007. $85 billion, betting housing prices keep rising and subprime borrowers keep paying. But housing prices couldn't rise forever. 2006, they stopped. Warning signs appeared 2006, but almost nobody paid attention. Home prices peaked mid-2006, started falling. Never happened in modern American history. Home prices always went up nationally. By early 2007, subprime borrowers defaulting at alarming rates, adjustable rate mortgages resetting to higher payments borrowers couldn't afford. Foreclosures accelerating, mortgage-backed securities Lehman and other banks held were losing value rapidly. February 2007, HSBC, one of the world's largest banks, announced massive losses on subprime mortgage portfolio. April 2007, New Century Financial, one of the largest subprime lenders, filed for bankruptcy. Warning shots. Wall Street ignored them. Lehman Brothers ignored them. Dick Gould told investors the subprime crisis was contained. Just a small problem in one corner of the market. Nothing to worry about. Summer 2007. Crisis spreading. 2 Bear Stearns hedge funds collapsed from subprime mortgage losses. August 2007. BNP Paribas, major French bank, froze withdrawals from 3 investment funds because they couldn't value mortgage securities in the funds. Market for mortgage-backed securities froze. Nobody wanted buying, nobody knew what they were worth. Credit markets seized. Banks stopped lending to each other because nobody knew which banks held toxic mortgage assets. Federal Reserve had to inject liquidity into banking system to prevent complete freeze. Lehman Brothers reported record profits 2007, $4.2 billion. But internally, executives panicking, Company had enormous real estate exposure, mortgages, mortgage-backed securities, CDOs, direct commercial real estate investments. If market kept declining, Lehman would face massive losses. Late 2007, Lehman's chief risk officer warned senior executives company's real estate exposure too high should be reduced. She was ignored. Early 2008, she was removed from risk oversight. Other executives raised concerns, told to stay quiet. Dick Fuld believed crisis was temporary, believed Lehman could ride it out, believed housing prices would recover. Wrong. March 14, 2008, Bear Stearns on verge of collapse. Bear was fifth largest investment bank in America. Like Lehman, massive exposure to mortgage-backed securities. Bear's stock had fallen from $170 per share a year earlier to $30. Overnight, about to hit zero, Bear Stearns relied on short-term borrowing funding operations. Every day, borrowed billions in repo market using assets as collateral. March 13th, Bear's lenders refused rolling over loans. Bear Stearns ran out of cash. Without emergency funding, Bear would file bankruptcy. Next morning, Federal Reserve, led by Chairman Ben Bernanke, and Treasury Department, led by Secretary Hank Paulson, faced a choice: let Bear fail or orchestrate rescue. They chose rescue. Fed provided $30 billion financing. J.P. Morgan bought Bear Stearns for $2 per share, later raised to $10. Bear's shareholders nearly wiped out, but company didn't collapse completely. Financial system saved from potentially catastrophic failure. Dick Fuld at Lehman Brothers watched this rescue, drew a conclusion. If government saved Bear Stearns, they'd save Lehman Brothers if needed. Implicit guarantee: big banks too big to fail. Government wouldn't let major investment bank collapse, but Fuld misread the situation. Bear Stearns' rescue had been controversial. Critics said it created moral hazard, encouraging banks taking excessive risks knowing government would bail them out. Hank Paulson, Treasury Secretary, hearing this criticism loudly, determined next major bank failure wouldn't result in government rescue. After Bear Stearns, Lehman had 6 months fixing problems, 6 months raising capital, selling assets, reducing risk, finding merger partner. 6 months saving itself, Lehman Brothers did none effectively. June 2008, Lehman announced $2.8 billion loss for second quarter. Company wrote down $5.6 billion in mortgage-related assets. Lehman's stock fell 10% single day. Dick tried raising capital, reached out to sovereign wealth funds, private equity firms, anyone who might invest. Potential investors looked at Lehman's books, saw massive losses hidden beneath accounting tricks, walked away. Lehman tried selling assets. Company attempted selling stake in investment management division. Talks with Korea Development Bank about possible acquisition went nowhere. Nothing worked. September 2008, Lehman Brothers out of time. Company had $639 billion in assets, only $25 billion. Equity, leverage ratio, 25 to 1. For every dollar equity, Lehman borrowed 25. This kind of leverage lethal. When asset values decline, Lehman's stock traded above $60 per share. Early 2008 fell to $14 by early September. Investors fleeing, clients pulling money. Just like Bear Stearns, Lehman's lenders in repo market getting nervous. September 9, 2008. Lehman announced third quarter loss $3.9 billion. Stock fell 45% single day to $7.79 per share. Rating agencies warned they might downgrade Lehman's debt. If that happened, Lehman would face immediate collateral calls it couldn't meet. Dick Fuld spent that week finding buyer. Bank of America expressed interest. Barclays, British Bank, also interested, but any buyer would need government assistance. Lehman's toxic assets too large. Buyer would need government-absorbing losses, just like J.P. Morgan received Fed support buying Bear Stearns. Friday, September 12, 2008. Treasury Secretary Hank Paulson called meeting at Federal Reserve Bank of New York. Every major Wall Street CEO summoned: Jamie Dimon from J.P. Morgan, Lloyd Blankfein from Goldman Sachs, John Mack from Morgan Stanley, Vikram Pandit from Citigroup, John Thain from Merrill Lynch. Paulson's message clear: Lehman Brothers is failing. We have two potential buyers, Bank of America and Barclays, but government will not provide taxpayer money facilitating deal. If Lehman's saved, Wall Street has to save it. A stunning reversal. 6 months earlier, Fed provided $30 billion helping J.P. Morgan buy Bear Stearns. Now Paulson saying no government money. Wall Street would have to absorb Lehman's losses collectively. Why the change? Politics. Paulson was Republican Treasury Secretary in final months of Republican administration. Bear Stearns bailout politically toxic. Couldn't go to Congress asking money bailing out another Wall Street bank. Wall Street CEOs spent Friday night examining Lehman's books. What they found worse than expected: Lehman had over $50 billion toxic commercial real estate assets worth far less than Lehman claimed. Losses catastrophic. Bank of America looked at numbers, walked away. Announced Saturday morning. They'd buy Merrill Lynch instead. Merrill, third largest investment bank, also in trouble. Bank of America decided Merrill better acquisition target than Lehman. That left Barclays as only potential buyer. Barclays wanted buying Lehman, but British regulators refused approving deal without government guarantee. Paulson wouldn't provide one. Saturday evening, Barclays deal dead. Lehman Brothers had no buyer. Government wouldn't help. Company out of cash. Sunday, September 14, 2008. Lehman Brothers Board of Directors voted filing Chapter 11 bankruptcy at 1:45 a.m. Monday, September 15th, filing submitted to bankruptcy court. 158 years, survived Civil War, 2 World Wars, Great Depression, multiple recessions. Gone. When Lehman Brothers filed bankruptcy Monday, September 15, 2008, it triggered financial earthquake nearly destroying global economy. Lehman's bankruptcy largest in American history. $639 billion assets, $619 billion liabilities. Bankruptcy filing itself, 900 pages. But size wasn't only problem. Lehman deeply interconnected with entire financial system. Company had over 900,000 derivative contracts with counterparties worldwide. When Lehman failed, all those contracts suddenly questioned who owed what to whom. Nobody knew. Stock markets collapsed. Dow Jones. Industrial average fell 504 points. Monday, September 15th. Largest single-day point drop since September 11, 2001. By week's end, Dow fallen over 1,000 points. But real damage in credit markets: banks stopped lending each other. Commercial paper market, where corporations borrow short-term funding, froze completely. Companies couldn't access cash-paying employees or suppliers. Entire financial system. Seizing. AIG, largest insurance company in America, on verge of collapse. AIG sold credit default swaps, insurance contracts on mortgage-backed securities. With Lehman's bankruptcy, AIG faced massive losses. September 16th, one day after Lehman failed, Federal Reserve provided $85 billion loan saving AIG. Government refused saving Lehman. Immediately rescued AIG. Money market funds, supposedly safest place parking cash, started breaking the buck. Shares falling below $1. Reserve primary fund, holding $785 million Lehman debt, announced it could only pay investors 97 cents on dollar. Panic spread. Investors pulled over $300 billion from money market funds in week. September 18, 2008. Hank Paulson and Ben Bernanke went to Congress, requested $700 billion bailing out financial system. Paulson told congressional leaders without this money, financial system would collapse within days. ATMs would stop working, businesses would fail, economy would enter depression. Congress initially rejected bailout September 29th. Stock market fell 737 points single day, largest single-day point drop in history. Congress reconsidered, passed Troubled Asset Relief Program, TARP, October 3rd. But even with TARP, damage spreading globally, Iceland's entire banking system collapsed. European banks holding Lehman debt faced losses. Emerging markets from Brazil to Russia saw capital flight. Global trade fell off cliff. Great recession begun. United States lost 8.7 million jobs. Unemployment hit 10%. 16 trillion household wealth destroyed. Housing prices fell 30% nationally, 50% some markets. Took until 2014 for employment recovering to pre-crisis levels. All started with Lehman Brothers. After Lehman fell, fingers pointed everywhere. Who responsible? Who should have seen it coming? Who could have stopped it? Dick Fuld testified before Congress October 2008. Grilled for hours, Congressman Henry Waxman asked about his compensation. Fuld defended decisions, blamed short sellers attacking Lehman's stock, blamed government not rescuing Lehman when they rescued Bear Stearns and AIG, blamed media creating panic, but Fuld never admitted Lehman's business model rotten. Company took reckless risks chasing profits. Lehman hid losses through accounting manipulation. Executives ignored warnings, doubled down on real estate when should have been reducing exposure. Hank Paulson also criticized, why save Bear Stearns and AIG but let Lehman fail? Paulson claimed he didn't have legal authority saving Lehman without congressional approval, but critics pointed out he found authority saving AIG one day later. Truth more complicated. Paulson wanted sending message bailouts weren't automatic, wanted imposing consequences for reckless risk-taking, chose Lehman as a line in sand, but Paulson misjudged how interconnected Lehman was with global financial system. Thought Lehman's failure would be contained. Markets had 6 months since Bear Stearns preparing. Lehman's bankruptcy triggered cascade, nearly destroying entire system. Rating agencies, Moody's and Standard & Poor's, also responsible. Given AAA ratings to mortgage-backed securities filled with subprime garbage, paid by investment banks rating securities, creating conflict of interest. When mortgages defaulted, ratings proved worthless. Regulators failed. Securities and Exchange Commission, Federal Reserve, Office of Comptroller of Currency had oversight over parts of financial system. None saw crisis coming, or if they saw it, didn't act. Banks themselves, not just Lehman, but Citigroup, Merrill, Lynch, Bear, Stearns, Washington Mutual, took same reckless bets, loaded up on subprime mortgages and complex derivatives because profits enormous and risk seemed distant. Entire system designed privatizing profits, socializing losses. Bank executives made hundreds of millions when times good, when times bad. Taxpayers paid bill. Lehman Brothers' most spectacular failure, but wasn't alone. Whole system broken. Within 2 weeks, Lehman's bankruptcy. Washington Mutual, largest savings and loan in America, failed. Seized by regulators, sold to J.P. Morgan Wachovia, another major bank, nearly failed, bought by Wells Fargo Merrill Lynch, rescued from bankruptcy by sale to Bank of America, revealed $27 billion losses fourth quarter 2008. Bank of America needed second government bailout completing merger. Goldman Sachs and Morgan Stanley, last 2 independent investment banks, converted to bank holding companies accessing Federal Reserve emergency lending. Investment banking model dead. Congress passed Dodd-Frank Act 2010. Most comprehensive financial regulation since the 1930s. Law created new oversight bodies, imposed higher capital requirements on big banks, tried preventing future bailouts. Critics said didn't go far enough. Banks spent last 15 years lobbying, weakening it. Not a single major bank executive went prison. Dick Fuld, never charged with crime, Neither were CEOs of Bear Stearns, Merrill Lynch, Citigroup, or AIG. Some firms paid fines, billions total, but fines paid by shareholders, not executives who made decisions. Most important point. Banks surviving got bigger. J.P. Morgan bought Bear Stearns and Washington Mutual. Bank of America bought Merrill Lynch. Wells Fargo bought Wachovia, too big to fail. Problem-causing crisis became worse after crisis. As of 2025, 4 largest banks in America, J.P. Morgan Chase, Bank of America, Wells Fargo, Citigroup, control over $10 trillion assets. That's 40% all bank assets. United States, they're larger, more complex, more interconnected than 2008. System-destroying Lehman Brothers wasn't dismantled. It was rescued, consolidated, made bigger. September 15, 2008 wasn't just day Lehman Brothers died. Day world learned financial system far more fragile than anyone believed. Lehman Brothers fell because it made reckless bets on real estate using extreme leverage, hid risks through complex financial engineering. But Lehman wasn't unique. Every major investment bank did same thing. Lehman just failed first. Government let Lehman fail. Sending message about moral hazard, but failure nearly destroyed global financial system. Within days, government abandoned that principle, bailed out AIG, Citigroup, Bank of America. Dozens other institutions. Lesson of Lehman Brothers should have been, banks can't be allowed growing so large and interconnected their failure threatens entire system. Instead, lesson Wall Street learned, if you're big enough and connected enough, government will save you, just don't be first one failing. Lehman Brothers sacrificed making political point, then government spent $700 billion bailing out everyone else, 158 years, $639 billion assets, 25,000 employees. All gone single weekend because executives chased profits, regulators looked away. Rating agencies lied about risk, politicians refused acting until too late. Lehman Brothers didn't fail from market crash or external shock, failed from greed, leverage, systemic corruption. Conditions destroying Lehman still exist today. Banks bigger, leverage returning, real estate overvalued, commercial real estate facing crisis. Right now, $1.5 trillion loans maturing through 2026. Regulators easing restrictions put in place after 2008. Next crisis coming, maybe real estate, maybe corporate debt, maybe sovereign debt, but coming because system wasn't fixed, papered over with central bank money printing and government guarantees. When next crisis hits, will government bail out banks again, or let one fail? Making point, just like they did with Lehman. If this showed you what actually happened 2008 and why it still matters today, subscribe, because Lehman Brothers' collapse wasn't the end. It was preview. System destroying Lehman still operating, risks still building. Next collapse could be even bigger. Question is whether anyone paying attention